Welcome to the deep dive. Today, we're diving into something pretty complex but super interesting. You brought to us how global economics and geopolitics really mesh together. You shared quite a bit of material, mostly from the CFA Level 1 curriculum, looks like. And wow, it covers a lot from, the basics of market structures, economic cycles.
All the way to international trade, currency markets, the big picture stuff.
Exactly. It's quite the range.
It is. It's a great set of sources because it lets us look at the world economy from, different angles. We can start with those fundamental economic ideas, how markets work, the rhythm of business cycles.
Right.
But then we get to layer in that crucial geopolitical element. How nations cooperate, how they compete, and how that shapes everything. Trade, investment, capital flows.
So that's our mission for this deep dive, right?
Yeah.
To connect those dots. We want to pull out the key insights from all this material and give you, our listener, a clearer picture of what's driving the global economy and how politics and economics are just so intertwined.
Yeah, it's sort of a shortcut to getting up to speed on these really important, complex topics.
Okay, let's jump in. Where should we start? Those fundamentals. Market structures and business cycles.
Sounds good. So when we talk about market structures, the material lays out a few main types. You've got perfect competition. Think loads of firms, identical products.
Like a big farmer's market, maybe, where everyone's selling similar apples?
Exactly like that. No single seller really controls the price. Then, way at the other end, you have a monopoly, just one big player calling the shots.
Okay.
And in between, there's monopolistic competition, lots of firms, but their products are slightly different, like coffee shops.
Right. Different brands, slightly different vibes.
Mm-hmm. And then oligopoly. That's where just a handful of big firms dominate. Think mobile phone carriers, maybe.
Yeah, definitely. And their pricing seems really interdependent. One cuts prices.
The others often react pretty quickly.
Exactly. And that brings up the Nash equilibrium idea mentioned in the context of oligopolies, right? It often leads to prices being kind of sticky.
That's it. In an oligopoly, the Nash equilibrium often means no single company can do better by changing its price or output on its own, assuming the others keep doing what they're doing.
So even if they could all make more money by raising prices together, they might hesitate.
Right. Fear of losing market share if they move first. Like you see sometimes with airlines, they might want to raise fares, but nobody wants to be the first one out there.
Makes sense.
And then there's the idea of scale. Companies get bigger, and initially their costs per unit go down. That's economies of scale.
You're getting more efficient.
But the sources also point out you can get too big. Diseconomies of scale. Efficiency drops. Costs actually start to rise again.
The GM example they used was pretty stark there, trying to manage too many brands, too much overlap.
Yeah, coordination becomes a nightmare. Labor costs might go up.
Yeah.
It really shows that scaling up isn't always automatically better.
Yeah.
There's a sweet spot. Those exhibits, 11 and 12, with the cost curves, they illustrate that visually.
Mm-hmm. The long-run average cost curves. And the comparison between U.S. and foreign automakers was interesting, too.
What jumped out at you from that comparison?
Well, it just highlighted how intense that cost competition is, especially globally. Seeing those foreign competitors often having a lower average cost really puts the pressure on.
Absolutely. It makes strategic decisions like GM selling off divisions seem, necessary to try and get back into a more competitive cost position.
Okay, so that's the firm level. Let's zoom out, like you said, business cycles.
Right. The material talks about growth cycles, fluctuations around the long-term trend, and growth rate cycles, which is more about the speed, the acceleration, and deceleration.
So slightly different ways of looking at the ups and downs.
Pretty much. But the basic phases are generally the same. Recovery, then expansion, then it starts to slow down, and finally, contraction or recession. Exhibits 2 and 3 lay those out.
And it's not just the overall economy moving through these phases. Different parts react differently, right? Like employment usually lags.
Yeah, that's a key point. Businesses tend to wait until they're really sure things are picking up before they hire lots of new people. So employment figures often turn up after the recovery has already started.
But capital spending businesses investing in new machinery, buildings, that sort of thing, that moves with the cycle. And it's more volatile.
Exactly. Pro-cyclical and volatile, as Exhibit 8 shows. It really depends on business confidence and, cash flow. When times are good, they invest. When things look shaky, they pull back fast.
Okay. And something that really fuels this cycle, or can make it worse, is credit. The credit cycle.
Oh, definitely. It's tightly linked. When the economy is booming, lenders are usually happy to lend, rates might be lower, makes it easier to borrow and spend.
Which adds more fuel to the expansion.
Right. But when things turn down, Lenders get nervous. They tighten standards, maybe raise rates, credit dries up. And that can really make the downturn much worse.
Almost like pouring cold water on it.
Exactly. And it can feed into asset price falls too, like housing. The 2008 crisis is the big, painful example of how interconnected the credit and business cycles are.
No kidding. So to track all this, economists use indicators, leading, lagging.
Nope. Leading indicators try to predict where the economy is going. Coincident ones move with the economy now, and lagging ones confirm what's already happened.
And there are composite indicators too, like the OECD one, combining several leading indicators.
Right. Trying to get a broader signal, reduce the noise from any single indicator. Diffusion indexes do something similar.
But the material warns about relying too much on just one number, right? The Kevin Durbin example.
Yeah, that's crucial. One good data point doesn't automatically mean everything's rosy. You need to look at the whole picture, multiple indicators.
Okay, makes sense. So that's the sort of natural rhythm of the economy. Now let's talk about how governments and central banks try to, well, manage that rhythm. Fiscal and monetary policy.
Exactly. Fiscal policy, that's the government's tool. Taxes and spending. Monetary policy is the central bank's domain, managing money supply, interest rates, credit.
And the goal for both is usually stable growth, low inflation.
That's the standard aim, yeah. Keep the economy growing steadily without prices getting out of control.
So looking at fiscal tools, we're talking government spending, infrastructure projects, transfer payments like unemployment benefits.
And taxes, of course.
Yeah.
Direct taxes like income tax, indirect like VAT or sales tax.
And the balance between spending and taxes gives you the budget deficit or surplus.
And the idea of automatic stabilizers is interesting, too. Things like unemployment benefits automatically kick in more during a recession, helping to support demand without politicians having to pass a new law each time.
Cushions the blow, sort of.
Exactly.
Now, national debt always seems to be a hot topic. The sources mention arguments for and against worrying about it.
They do. Some focus on the debt-to-GDP ratio, potential crowding out of private investment. Others argue it's manageable if the economy is growing or necessary in a crisis. It's complex.
And what makes for good tax policy? Simplicity? Fairness?
Simplicity, efficiency, meaning it doesn't distort economic decisions, too much fairness, and revenue sufficiency, it actually brings in enough money. But there are always trade-offs.
Like the Laffer curve idea, that
Yep.
taxes can affect incentives.
Right. The idea that if tax rates are too high, cutting them might actually increase government revenue because people work or invest more, though finding that exact point is famously difficult.
And a big challenge for fiscal policy is timing, isn't it? The lags.
Huge challenge. First, you have to recognize there's a problem. That takes time. Then politicians have to agree on what to do and pass the action lag.
Which can take ages.
Can definitely take ages.
Yeah.
And then it takes time for the spending or tax changes to actually ripple through the economy, the impact lag.
So by the time it hits, the situation might have changed again.
Precisely. Ricardian equivalence is also mentioned this theory that maybe people anticipate future tax changes, so they save more now if the government borrows, kind of offsetting the stimulus. It's debated, but it adds another layer of complexity.
Okay, so that's fiscal policy. What about the central bank's side, monetary policy?
Their main tools are different. Open market operations, buying and selling government bonds to influence money supply and interest rates.
The main policy rate is key there.
Absolutely. That target rate influences all sorts of other interest rates, mortgages, business loans. They also use the repo market, where banks lend to each other overnight, and sometimes reserve requirements, how much cash banks have to hold.
And that policy rate affects more than just borrowing costs.
Oh, yeah. It hits asset prices, stocks, bonds, affects the exchange rate, and it shapes expectations, what businesses and consumers think will happen next with inflation and growth.
And for this to work well, things like central bank independence are important.
Crucial. Independence from short-term political pressure. Credibility people have to believe the central bank will do what it says. And transparency, being clear about its goals and actions. That's all key for successful inflation targeting.
Some emerging markets peg their exchange rate instead, though.
Yes, that's an alternative strategy, especially for smaller, open economies. Fix their currency to, say, the US dollar or the euro. But it means giving up control over domestic monetary policy.
And central banks don't have total control over money, right? Even with fiat money, where they're the only ones printing the currency.
No, they don't. They can influence the base money supply, but how much that gets multiplied through bank lending depends on banks' willingness to lend and people's willingness to borrow and hold money. And their role often extends to supervising banks, too, like in many G10 countries mentioned in Exhibit 1, though not all.
So monetary policy can be tightened contractionary, raising rates to cool things down, or loosened expansionary, cutting rates to boost things.
That's the basic idea, but it also has limits.
Like what?
Well, supply shocks like a sudden oil price spike can push inflation up and slow growth. That puts the central bank in a tough spot.
Choose between fighting inflation or supporting growth.
Pretty much. And market expectations matter hugely. If people don't believe a rate cut will work, it might not. And there's the risk of a deflationary trap where prices are falling and even zero interest rates don't encourage borrowing. Japan struggled with that.
Which is where things like QE come in, quantitative easing.
Exactly. Unconventional policies. When you can't cut rates any lower, you try buying assets directly to pump liquidity into the system, like the US and UK did, QE1, QE2, after the 08-09 crisis.
Okay, so we have the domestic tools. Now let's really bring in the global dimension, geopolitics and globalization.
Right. Geopolitics fundamentally is about how nations interact, sometimes cooperating, sometimes competing, and it's driven by this mix of, well, economic interests, security concerns, financial power, even social and cultural factors.
So a country's economic health is tied up with its bigger national goals.
Deeply intertwined. And things like national security needs, or just plain geography being landlocked, having valuable resources really shape how countries engage with each other.
And this idea of a hierarchy of national interests, survival first.
Yeah, survival and security are usually paramount. Then come other goals like economic prosperity, influence, promoting certain values. Governments sort of weigh these when making decisions.
And political cycles matter too. How often elections happen?
Apparently so. The suggestion is that governments facing frequent elections might prioritize short-term wins over tackling long-term, perhaps more important, geopolitical or economic challenges.
Interesting. Okay, how does this tie into globalization?
Well, globalization is that increasing interconnectedness, trade, investment, information flowing across borders. Exhibits 4 and 5 show this trend, trade as a percentage of global GDP rising, complex global supply chains like in auto manufacturing.
What drives it? Profits.
That's a big one. Companies looking for bigger markets, cheaper labor or resources, accessing specialized knowledge. Sometimes just the inherent benefit of connecting and sharing ideas.
But it's not all positive, is it? The sources mention costs and threats of a rollback.
Definitely not all positive. Increased competition can hurt domestic industries. Concerns about rising inequality within countries, job losses in some sectors.
And supply chain fragility, that semiconductor shortage was a huge wake-up call.
A perfect example. Suddenly, car production lines stop because a chip made halfway across the world isn't available. It highlights the risks of these super-optimized, interconnected systems.
So that leads to talk about reshoring, regionalization.
Yeah, potential responses, maybe bringing production closer to home or focusing trade within regional blocks, or companies doubling down on just a few really key international markets instead of trying to be everywhere.
And managing all this global trade relies on international organizations.
Very much so. You have the WTO World Trade Organization, evolving from GATT, setting the rules for trade, settling disputes.
The IMF, International Monetary Fund.
The IMF focuses on global economic stability, helping countries with balance of payments problems, acting as a lender of last resort in crises, think Greece.
And the World Bank.
The World Bank Group is more focused on long-term development, reducing poverty, funding projects in developing countries. Exhibit 8 gives a snapshot of the kind of global data they work with.
And there are different models for how countries interact globally, right? From total integration to isolation.
Yeah, Exhibit 7 shows that spectrum. Multilateralism at one end, deep integration, lots of cooperation like the EU is supposed to be, and autarky at the other, trying to be completely self-sufficient.
And Brexit would be a move away from that deep EU integration.
A significant move, yes. Yeah. Exhibit 10 positions it that way. It even touches on how geopolitical events can shift comparative advantage. The example of Germany taking in Syrian refugees, influencing its labor market and economy.
Fascinating how these things connect. Okay, so if geopolitics creates risks, how do investors deal with that?
It really varies. Depends on their goals, how much risk they can stomach. Some might just see it as a background factor, maybe slightly adjusting discount rates for riskier regions.
While others might actively trade on it.
Potentially, yes. Seeing geopolitical shifts as opportunities for alpha, for generating excess returns, though that's obviously a high-stakes game.
What kinds of geopolitical risk are there?
The material breaks it down into 3 types. Event risk, tied to specific dates, elections, policy changes. Brexit is the classic example.
No.
Then exogenous risk. Sudden, unexpected shocks, think natural disasters, coup.
Stuff out of the blue.
Right. And thematic risk. Trends that build over time, like cybersecurity threats becoming more prevalent. The Equifax breach in Exhibit 13 is used as an example of the impact.
And these risks can hit just one company or spread much wider.
Exactly. Could be very specific, or it could ripple through entire markets or even the global economy.
How do people even assess these risks? Read the news.
That's part of it. Keeping track of political calendars, potential flashpoints, but also more formal methods like developing quantitative scenarios, trying to model the potential impact of different geopolitical events.
And where do we see this risk in the markets? Volatility.
Definitely volatility. In commodities, oil prices reacting to Middle East tensions, for example, currencies, stocks, bonds, they all react. Exhibit 15 shows the market chaos during the start of the COVID pandemic.
Right.
It can also mean investors demand higher returns, higher discount rates for investing in places seen as politically unstable. And you see it in capital flows, money moving quickly out of emerging markets if perceived risk spikes.
And governments have their own geopolitical tools beyond just diplomacy.
Oh yeah, military force and alliances are the most obvious. But economic tools are huge: trade agreements, sanctions, controlling foreign investment, even nationalizing assets.
And things like cabotage, limiting foreign ships or trucks.
Yeah, the material calls those multifaceted tools. They have clear economic impacts, but often serve strategic or security goals too.
Okay, we're getting a really broad picture now. Let's drill down into the mechanics of international trade and currencies, the nuts and bolts of global economic interaction.
Sounds good. So international trade, the benefits are pretty clear, right? Specialization countries focus on what they do best.
Gains from exchange.
Exactly. Economies of scale from producing for a global market. More product variety for consumers. More competition, which drives efficiency. Better resource allocation globally.
Newer trade models also talk about variety and competition, explaining why countries trade similar goods, like importing and exporting cars.
Right. Intra-industry trade. It's not just about countries trading completely different things based on resources, but also gaining from variety and scale within the same industry.
But there are costs. We mentioned job losses in import-competing sectors, inequality.
Those are the major downsides, yes.
Yeah.
The overall pie might get bigger, but some slices can shrink, leading to social and political friction.
Which leads governments to put up barriers sometimes. Tariffs.
Tariffs are taxes on imports. They raise prices for consumers, protect domestic producers, but generally reduce overall economic welfare, creating that deadweight loss shown in Exhibit 1.
What about quotas?
Quotas are direct limits on the quantity of imports. They also raise prices, but the extra profit, the quota rent, often goes to the foreign producers who are lucky enough to get an import license.
And VERs, export subsidies, other ways to restrict or distort trade?
Yep, voluntary export restraints, where the exporting country agrees to limit exports. And export subsidies, where the government pays its own firms to export, which also distorts markets.
Then there are trading blocs, countries getting together to lower barriers among themselves.
Right, different levels of integration. Free trade areas, FTAs, just remove internal tariffs. Customs unions add a common external tariff.
Common markets allow free movement of labor and capital, too.
And economic unions go even further, coordinating economic policies, sometimes even sharing a currency, like the Eurozone.
The goal is trade creation, more trade within the bloc.
That's the main benefit they hope for. But there's that risk of trade diversion we mentioned, shifting imports from a more efficient outside supplier to a less efficient inside supplier just because of the preferential tariffs.
And deeper integration isn't easy. Sovereignty concerns.
Big challenges. Giving up national control over policy, cultural differences, coordinating fiscal policies. The Greek crisis really exposed those tensions within the Eurozone.
Okay, let's shift to the FX market, foreign exchange. Huge market, right?
The biggest financial market in the world by trading volume. Essential for all this international trade and investment.
Need to distinguish nominal versus real exchange rates.
Absolutely. Nominal is just the rate you see quoted how many yen per dollar, for instance. Real adjusts for inflation differences. It tells you about actual purchasing power changes between countries.
There's a formula for that. And example 6 showed how it works.
Right. It shows how even if the nominal rate stays the same, if one country has much higher inflation, its currency's real purchasing power is falling. PPP, purchasing power parity, is the theory that, in the long run, exchange rates should move towards equalizing prices of identical goods.
Who are the main players in this FX market?
Big players. Central banks are in there, managing reserves, sometimes intervening to influence their currency's value. Global reserves are massive, nearly $13 trillion end of 2021, mostly U.S. dollars and euros.
Then the banks.
Yep, the sell side, the big dealing banks making markets, trading amongst themselves in the interbank market.
And the buy side. Everyone else.
Pretty much. Financial institutions like investment funds, pension funds, hedge funds, they're actually the dominant volume according to Exhibit 3. But also non-financial companies doing international business, tourists.
How are rates quoted? Direct, indirect. It can seem confusing.
It depends on market convention for each currency pair. Direct quote is home currency per unit of foreign currency. Indirect is the opposite. Exhibit 4 lists the conventions for majors. Base currency versus price currency is the key distinction.
And volatility here really matters for businesses.
Huge implications for risk management if you're importing, exporting, or have foreign assets liabilities.
And countries choose different systems for managing their rates, exchange rate regimes.
Yeah, Exhibit 6 shows a whole spectrum. At one end, no separate currency at all, dollarization, or a monetary union like the euro.
Currency boards like Hong Kong.
Right, rigidly fixed to another currency, with reserves backing it. Then various types of pegs, fixed parity, target zones, crawling pegs where the rate adjusts gradually.
And then more flexible systems.
Managed floats, where the central bank intervenes sometimes but doesn't target a specific level, and independent floats, where the rate is basically set by the market.
And the choice affects independence in monetary policy and capital flows.
Big time. You generally can't have a fixed exchange rate, free capital movement, and independent monetary policy all at once. It's often called the impossible trinity. Historical events like the ERM crisis in the 90s or the Plaza Accord in the 80s show governments trying to manage these trade-offs.
Governments also sometimes restrict capital flows directly.
Yes, capital controls, limiting money coming in or going out.
Why would they do that?
Various reasons cited. Protect jobs, develop certain regions, strategic industries, manage the balance of payments, maybe prevent a financial crisis, or manage one if it happens. Malaysia's controls in the late 90s are often discussed in this context.
Restricting foreign investment coming in or stopping domestic money going out.
Can be either or both. Controls on inward investment, controls on outward investment, they're controversial. Can they work? Are they desirable? Big debate.
And finally, arbitrage keeps the FX market efficient.
Largely, yes. Arbitrageurs look for tiny price discrepancies. Calculating cross rates, like the KDEUR or JPY-CAD examples, relies on arbitrage ensuring prices are consistent. If you can buy low in one place and sell high elsewhere risk-free, people will do it until the prices align.
And forward rates relate to interest rates.
Exactly. The difference between the spot rate, today's price, and the forward rate price for future exchange reflects the interest rate difference between the two currencies. That relationship, based on arbitrage, is captured in the formula provided. It prevents easy risk-free profits from just borrowing in one currency and lending in another.
Wow, okay. That was definitely a deep dive. We've covered a huge amount of ground connecting the dots between firm behavior, economic cycles,
Government policies, fiscal and monetary,
the massive impact of globalization and geopolitics.
and then the actual mechanics of trade and currencies. It's all interconnected.
It really is. And hopefully seeing how these pieces fit together provides a much clearer framework for understanding the global economy and what drives financial markets.
Yeah, it's complex, but having this kind of map helps make sense of the headlines and the market movements.
So maybe a final thought to leave our listeners with. Given how hard it is to predict economic twists and turns or geopolitical events, and knowing policies can have unexpected side effects, how can people or businesses best position themselves? How do you prepare and adapt when the global environment is just constantly shifting like this?
That's the million-dollar question, isn't it?
Mm-hmm.
Constant vigilance, flexibility,
Yeah.
definitely something worth thinking more about.
Absolutely. And is any one piece of this market structures, central banking, trade rules, whatever, really caught your attention?
Then hopefully this overview gives you a solid foundation to explore that specific area in more detail. There's always more to learn.